Ladies and gentlemen, the indicator that has predicted every single recession throughout history is flashing code red right now. In this video, I'm going to prove to you with news, facts and data why we're heading dangerously close to a recession, what is causing it, and how we can prepare so we're not affected. Because ladies and gentlemen, the world around us is changing and changing rapidly, and the world order structure is about to change forever. So everyone, without further ado, you know what time it is. Let's get straight into the news, the facts, and the data. Well, okay, first things first is this, everyone. The Federal Reserve's favorite recession indicator is flashing a danger sign yet again. So what exactly is this indicator? How reliable is it? And what is it signaling right now? Well, let's dig a bit deeper. Well, what it is, everyone, it's called the yield curve, or the yield curve inverting between the 10-year Treasury yield and the 3-month Treasury yield. And we can see it has inverted and is still inverted. And if this continues on, it's going to signal stronger and stronger that a recession is going to be coming. Because CNBC goes on to report, though markets more closely follow the relationship between the 10 and 2-year note, the Fed prefers measuring against the 3-month as it is more sensitive to movements in the central bank's federal funds rate. And the 10-2-year spread has held modestly positive, though it has also flattened considerably in recent weeks. So this is what the big money, this is what the market makers behind the scenes, behind the curtains, use to signal that there is trouble in the financial system and for the economy coming ahead. Because this goes hand in hand with the recent data we got with the University of Michigan's monthly survey. Respondents put their longer-term view on inflation over the next 5 years at its highest level since 1995 on Tuesday. That is forward-looking expectations, and the index has sunk back down to levels consistent with recession in February. So you, the viewer, you know that it feels like we're already in a recession, but now we're getting the data, because the data always lags what the real average American knows. The cost of living is getting so hard. Rent, groceries, utilities are so expensive, people simply don't have money left over to go out there and spend in the economy. Now, in response, traders are now pricing in at least 0.5 percentage point of interest rate cuts this year from the Fed, an implication that the central bank will ease as growth slows. This is according to the CME Group's FedWatch measure of future prices. And according to experts, the bond market smells recession in the air. But know what you may be thinking, well, look, this is just one indicator and it may not always guarantee that we head in a recession, even though it has predicted 9 out of the 10 past recessions. But I've got even more proof and more stories to show you that things for the economy, with recent announcements from the Trump administration, with DOGE, with the housing market, that things aren't looking good. Because look at this, everyone. New home sales plunged 10.5% in January from an upward revision. So that shows us that people simply don't have the money to pay for these crazy new home costs that have gone up massively since COVID to build a new home. And they also can't afford to pay these much higher interest rates, nearly double or triple in many circumstances. And simply the average home in not just the US, but around the world, in Australia, Europe, UK, is now out of reach for the average working class. But the big thing that's been stopping a real recession coming, even though people's living standards have been falling, is mass layoffs. We have had some layoffs, but we haven't seen the unemployment rate go above the 5 or 6% that signals a real recession is coming. But now experts are starting to calculate how much jobs could be laid off with DOGE, with what Elon Musk is doing. And there could be up to 1 million jobs lost, which will have massive ripple effects for the whole economy. So look at this, everyone. DOGE this. DC may top 1 million layoffs and recession risks soar as jobs and housing sour. So let's dive a bit deeper into this report and exactly what's going to happen. Because look at this, everyone. DOGE wins as DC jobless claims soared last week. We can see here, massive jobless claims all of a sudden spiked. And this is only the beginning. So the Trump administration epic purge of federal workers is shaping into one of the most significant job cuts in a generation. Because what has avoided recession, not just in the US, but many other countries, same here in Australia as well, is government spending has done all the lifting. They've spent trillions and trillions of dollars in the US, hundreds of billions of dollars across the world on stimulus, on government projects. And that's what's kept the economy afloat. But if governments all of a sudden stop spending, because they have no choice. They're going bankrupt while we're going to see massive economic contraction. So early indicators suggest North Virginia, Washington, D.C., and Maryland may be in the beginning innings of an economic downturn as jobless claims rise and a surge in active housing listings signal a very ominous outlook. But okay, how did they get to their figure that 1 million jobs could be lost? On Thursday morning, chief economists at Apollo joined Bloomberg TV, warning the consensus expects total DOGE-related job cuts to be 300,000. However, studies show that for every federal employee, there's 2 contractors. Now, I'll go even further to say what happens in the economy is one person's spending is another person's income. So if all of a sudden these hundreds of thousands of US government employees get laid off, well, then that means the shopping malls they normally go to won't have income. That means the cafes they normally go to, the restaurants, the subscriptions they paid for will be cancelled, and that's going to have a domino effect across the whole economy. But what's really scaring the market and what's really worrying investors right now, there's a lot of uncertainty with what's going to happen with Trump's trade war 2.0. We saw what happened in his first term during 2018 when he went into a trade war with China. And late 2018, I don't know if a lot of you guys remember, but I remember like it was yesterday, the stock market, the S&P 500 and the Dow plunged 20% in a matter of months. But will this time be different? Let's have a look. So Trump's tariff push has spooked investors, and here's what it could take for him to step in and stop the selling. Because we all know, like what happened in his first term, he liked the stock market. When the stock market was doing good, he thought that's because he's doing a good job. When the stock market started to sell off, he started to tell the Federal Reserve, start cutting interest rates. He went a bit lighter on the trade wars. But a lot of people are saying maybe it's going to be different this time with a massive amount of US government debt. And this is what economic commentators call the Trump put. So put simply, the Trump put, it would be, for example, if the stock market started to rapidly sell off and it was falling 10%, he may ease up on his tariffs on other countries, or he may ease up on the layoffs, what's happening with the government. He may announce more stimulus measures. Now, this is what's also some people call the Fed put. When the stock market may plunge 10 or 20%, the Federal Reserve may jump in and say, look, we're not going to do quantitative tightening anymore. They may announce more interest rate cuts. And many people have had, some conspiracies that the Federal Reserve has sold a put contract on the entire market, and put sellers are obligated to buy shares if the price falls far enough below a certain level. So does the Federal Reserve, does the US government have a contract that says if stocks fall 20, 30, 40%, we are going to secretly go in there and buy up shares to stop the house of cards from falling down? Now, they've said the central bank or the federal government doesn't really have a put contract to go out and buy them stocks themselves. Rather, it's a metaphor for rhetoric or direct actions that could inspire investors to buy. So even if they don't, you better believe they do have certain levels where if they see the markets all of a sudden start plunging, they will jump in there and give very positive economic comments, very positive market data. They might smudge the numbers a bit to make them look a bit better, and they will change their policy, like what we saw in the UK when Liz Truss announced all these policies, and then the bond market started to sell off. They jumped in and intervened immediately. Now, this is like what I was talking about earlier during Trump's first term, so we can get an idea of what he may do this term. That was where the S&P 500 fell 20% from its peak to its trough, and instant wiping out gains from earlier in the year as Trump trade war with China and the Federal Reserve interest rate hikes rattled investors. And we're having pretty much deja vu. This is happening again. So once the index had fallen by about 10% from its highs, chief strategists at Deutsche Bank observed a shift in the administration tactics. Instead of pushing the envelope further, Trump quickly struck a deal with China to end the trade war. But at that time, it didn't do much to immediately reassure investors, because once there's panic in the streets, it's very, very hard to stop the bleeding. Now, the administration tried again when on Christmas Eve of 2018, Treasury Secretary Stephen Mnuchin said he had calls with leaders of the largest US banks and investors and didn't take kindly to the news, and the sell-off accelerated despite Mnuchin saying that the CEOs had assured him that the banking sector had ample liquidity. And this just shows you how weak the house of cards really is, and it's all built on faith and trust and the backing of the Federal Reserve and the US government to bail out the market. So that leads us to the next discussion. Well, what will it take for them to do something now? And many commentators are saying they would need the S&P 500 to fall at least by 10% for him to jump in. But there's a big risk. What if there is no Trump put this time? What if he doesn't really care as much about the S&P 500 as his first time? And this time, a lot of people are saying maybe him and Elon Musk are more focused on the bond market. Because again, going back to what I said earlier with the lid trust situation, a lot of investors are very, very worried about the massive amounts of US government debt, and that's led people to sell off bonds. But if bond yields continue to go up, that's going to be more yield, that's going to be more interest on those bonds that the government has to pay, and it's going to be a massive, massive expense. So if they can get investors back into the bond market and interest rates go down, well, that's less interest the US government has to pay. Because Elon Musk recently commented on this. He said on a conversation on X earlier this week, Musk, who played a major role in guiding the administration ordered spending cuts, and said the commitment to reining in the US budget deficit had helped boost demand for bonds, and that helped inspire talk of the real Trump put might apply to bonds, not stocks. Elon Musk said, if you're shorting bonds, I think you're on the wrong side of the bet. So everyone, I know that's a lot of economic data and a lot of economic jargon. So I know what you're wanting to know is, well, okay, what does this mean in simple terms? What this means is the bond market is signaling that something big is about to be coming, a recession or maybe even worse. Governments around the world are heavily indebted, and they're not going to be able to provide as much stimulus as they did during previous times, and if they do, inflation will surge. And what this is all leading to is stagflation, where we're going to have prices continue to go up, but the unemployment is going to go up as well, and central banks won't be able to intervene, because if they do, inflation will get even worse. So the only solution to this is to let the market figure out what the fair value is, stop the government intervention, stop the central bank intervention of propping these markets up, and let it reset to what the average American can afford to pay, not what the government wants you to pay or central banks. Now, know what else you're thinking? Well, how can we prepare? Well, what have I been saying, everyone? You want some gold and silver in your portfolio, because when there's going to be very, very bad economic news, gold and silver will initially sell off because people may have to sell their gold and silver to pay off some margin, or whenever there's a huge sell-off like we saw today, gold and silver gets tied up in it as well. But when there's a lot of geopolitical risks, we're going to see central banks, the US government right now, everybody's rushing for gold because they know fiat is dying. Everyone wants the real wealth, what real money is, gold and silver, and all these fiat currencies eventually will fail. And even if you just have 10 gold coins or 100 ounces of silver, you will be in the top 1% when it all resets. But everyone, what do you think about all this economic craziness that's happening right now? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.